Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the SP 500 that has really been whipsawing around traders and investors alike. People don't know really what to expect next in this crazy market. Just taking this chart as an example, this must have absolutely wrecked a huge number of people. This head and shoulder pattern here that really everyone's been talking about for months now. It broke down back in May and then we snapped back above it, and now the S&P 500 is battling to stay above it. Was this a whipsaw or is this a whipsaw? We're going to get back below it. We're going to be diving deep into the technical analysis of the S&P 500 today, taking a look at a few developments that we've seen over these past couple of weeks, what we're watching out for in the next couple of weeks. I hope you guys will enjoy this one. If you do, don't forget to click on that like button and subscribe to the channel. If you are new here and you want to follow these crazy markets with us. And now without further ado, let's get right into it. So item number 1 on the list of things to discuss is this head and shoulder breakdown or false breakdown on the S&P 500. From just a technical standpoint, looking at this is a bullish development. Now, take it for what it's worth, because if we break back down below, well, it no longer looks like a bullish development. But as long as the S&P 500 holds above this trend line, especially on a weekly closing basis, we want to see the S&P hold above this trend line. If that's the case, this is a pretty bullish setup, and I'm going to show you the details of that. But before I do, let's go back to something that we've discussed in the past. Let's zoom back out to 2010. And you had a very similar type of development where you had this type of major head and shoulder pattern that everyone was looking at. A lot of investors were very bearish on the market right here in this zone. And keep in mind, this is right after the great financial crisis, right? So just try and imagine the context behind this setup here. You're looking at this chart. Right there, you have the great financial crisis in the rearview mirror, and you have this massive head and shoulder pattern developing that's broken down. It's very difficult by looking at this chart not to expect, at the very least, a large move back down in the stock market, and potentially even a resumption of this bear market that we had since 2007. So hopefully this gives you a little bit of context behind that. We did have that breakdown, but then very similar to what happened just last week, we snapped back above it very impulsively, retested that trend line, and then the market moved higher again. So that's a typical example of a place where you can get whipsawed around and really get absolutely wrecked if you're actively trading these levels on a pattern that pretty much everyone is looking at, right? I can guarantee you that everyone was looking at this head and shoulder back here, just like everyone was looking at this head and shoulder right here in May. So seeing price snap back above it, that's promising, as we've been pretty bullish on the market over these past few weeks, expecting some type of a bottom to occur, waiting for that sharp recovery that we did get. So this is nice. It recovered some of that technical damage. Now we need to see that hold if we want to continue being optimistic. So hopefully these videos are bringing about a little bit of context. This is a very interesting post that I retweeted at the beginning of the week, I believe, and it gives you the number of news articles mentioning bear market rally that has skyrocketed. You look anywhere on social media, on YouTube, and everyone's talking about a bear market rally. And so I always believe that it's important to be skeptical of what the herd is doing, and being bullish right now is pretty contrarian. Now, just because a call is contrarian doesn't mean it's right. And I think that's an important distinction to make. Sometimes the consensus view that everyone agrees on ends up being right. And that's just part of being in the market. But from the indicators that we like to look at, and this is one of them, the NYSE volume day tells you the percentage of stocks that saw their volume in the green. And so what this chart from Sentiment Trader shows you is every time the market saw 3 consecutive days where you had over 80% of stocks in the NYSE showing up volume. And you can see it's only happened really a handful of times, even in the past 10, 15 years. It tends to occur at the very beginning of moves up in the market. COVID, 2016, that case study that we just talked about in 2010, where you had that false breakdown below the head and shoulder pattern. You had 3 consecutive up days right before a big rally in 2011. And then here in 2008, you had 2 of these readings, one of them being before a big drop. So that is one more thing I wanted to add, is that clearly this is, again, not a perfect indicator. You had 3 up days, 3 consecutive 80% up days right here. Let's measure that up right before a 30% drop in the market in 2008. So that is a big whipsaw. If you were using that back here as a signal to enter the market for a nice trade and you were buying call options here based on that signal, well, you got absolutely crushed. So that's important to note here. And to put a little bit of context behind all these developments, if we go back further in history, in the 80s, they also corresponded to the beginning of big run-ups in the market. This is another exception here. This was actually right at the top of a bull market and right before a bear market. So that's an exception. But in general, these were very positive signals. So again, if we zoom in and focus a little bit more on the technical picture of this setup here on the S&P 500, you can see we have some pretty interesting levels. Let's take a look at the daily chart, for example, here. And you can see we have some sort of a head and shoulder pattern developing here. Now, it is not very pretty, and I'm sure a lot of people will argue that it's a stretch calling this a head and shoulder pattern. But what I often say is the head and shoulder patterns I like the most are the ones that not many people are looking at, but still fit my criteria of a head and shoulder pattern. If we put this on a line chart, well, you can see that it pretty much respects everything that a head and shoulder pattern needs to respect. And so that is a bullish setup, right? By itself, it's a bullish setup, but it needs to break out in order to be confirmed. If it breaks out, you're looking at a nice move up on the S&P 500, a swift move up. If we reject here and we start to close below this trend line that we've been looking at, right, that we already got whipsawed once back here in May, could that happen again? Of course it can happen again. We could move back down here and close back under this line. And in that case, you start to lose that head and shoulder structure and you start to, again, get into the scenario where you're looking for new lows to be made. And that's when this type of data here becomes a lot less relevant, right? Because what this essentially tells you, this S&P 500, 3 consecutive 80% NYSE up volume days, it's very compelling. It's very beautiful. But what you tend to need to see for that to lead to a rally is that it needs to materialize into a rally very rapidly. You can see it happens and the market follows through on that move and it leads to more upside, right? It occurs at the very beginning of a move and there's follow through on the S&P 500. If you don't see follow through in the days and weeks after that reading, well, you start to get into these exceptions. And so it becomes an exception and essentially a whipsaw signals. So that, of course, depends on your risk tolerance and how much weight you're willing to put on this data. And in fact, this is far from being the only data point that we've been covering. This article that I wrote here at the very beginning of the week highlights a lot of these developments, like the strength that we saw in the junk bond market, the strength that we saw from a breadth standpoint that usually corresponds to the very beginning of rallies. So there's a lot of evidence that's mounting to actually be potentially the beginning of a larger move up in the market. But that's really going to be one of our focus points. We're going to be actively watching these levels. We also have quite a few very significant significant resistance levels that we're looking at. These moving averages here, the 100, 150, 200 day moving averages, and these trendline resistance levels. First one that has already been hit here, you can see this nice trendline resistance. We hit it beautifully, and now the price is sandwiched between that head and shoulder neckline that we're talking about and this resistance line that we've been watching. So this is a pivotal moment, in my opinion, for the S&P 500, because we've had a lot of these bullish signals that suggest the market should be heading higher right now. If that gets confirmed, then we need to be watching how price behaves along the way, what kind of developments we see along that price movement. And if we see a break back down, then that's very bad news, and it negates a lot of the bullish evidence that was mounting over the past week or so. So very pivotal moment. We're going to be watching that in detail with you guys, and we are going to be making real-time updates on the market as we see these developments play out, to give you guys some notification updates as we see these pivotal price movements on the S&P 500. So if you want to have access to those updates and to all of our research, make sure to go to gameoftrades.net. There is a 7-day free trial. We really try and give access to this research and to these updates to as many people as possible. So I hope you guys enjoyed this video. If you did, make sure to click on that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.